Hey, it's Ian Flanagan here from freedominvestingacademy.com, and in this video I want to give you some really good gold nuggets about how to structure private money deals. But just as a disclaimer, I'm not a real estate attorney, I'm not a CPA, so if you're borrowing money and you have questions, please consult your professionals. So why would a private lender loan you money to buy real estate? Well, it's very simple. There's collateral there. The house is collateral. So the investor is vesting in a property that is a real asset that he could get cash flow off of, or some type of equity out of the deal, or something to that effect. But the security of an investor to want to put their money or even loan you the money to buy a piece of real estate, number one, it's the collateral. It's a real asset. And you want to give your private lenders first lien position always. That's a good secure position. They have the senior position in the deal, so if the deal goes south, then that person can take the property back. So your note and deed of trust. So a lot of terms in the industry is called, for lenders, is called deed of trust investing, because that's the instrument that collateralizes, the money to the property. So whenever you get the deal negotiated with a private lender, you're going to sign a loan agreement. It can be called a master's and security agreement. There's a lot of different terms for what that is, but it's basically a loan agreement. So you want to get one of those signed, and that's something that you or your attorney would want to draft up if you don't already have one. Now the note and the deed of trust, the attorney at the title company will draft up. And then once you're ready to close on the property, the funds get wired into escrow. So you're not getting the funds personally, sent into your bank account. You are wiring it into escrow. You want to make sure that the collateral is, the house, their money is collateralized by the note and the deed of trust, and they're getting a first lien position. You want to have a loan agreement in place, and you just want to make sure you do it proper. So I have two ways here that you can think about structuring private money deals, and one is just short-term financing for flips, and the second is the long-term financing for buy and hold. So here are some ways that I've structured deals, and just to give you an idea, everything is negotiable here. So anywhere from 8 to 12%. Hard money lenders now are charging up to 14 and 16% with a lot of points. But private money is very different than hard money, because private money is typically from individuals and not from loaning institutions. So you have a lot more flexibility in the loan agreements and the ability to get cash available to you, because investors are looking for the collateral, they're looking for the cash flow, they're looking for that secured investment. So 8 to 12% on flips is pretty much typical. Accrued interest, this is one of my favorites here. Accruing the interest just means that, yes, interest is accruing daily, but you're not going to make that payment, so you basically have no payments until you sell the property. So if it takes you 5-6 months to get the deal done, at the time of closing is when you basically pay all your interest. So that's what accruing interest is. It just means that you're going to pay them once the deal is done. Equity kickers, anywhere from 10 to 30%. So let's say you have an 8% loan, and just to sweeten the deal just a little bit for your private lender, you're going to give them an equity kicker of 20% of your net profit. So if you don't have any capital in the deal of your own, then why wouldn't you agree to that, right? If somebody's going to put the money up for you to do the deal, so you can give them a nice rate of return on their cash, it's not out very long, but hey, whatever my net profits are, I can give you a little equity kicker there. So another structure is common, which is just a joint venture, like a 50-50 type joint venture, where the private lender will put up all the cash, and then once you do everything you need to do to the property and get it sold, then you just split the profits 50-50 right down the middle, whatever the net proceeds are. Obviously they get all their money back that they put into the deal, but you want a joint venture 50-50. So that's another very common structure. And you can do a combination of all these too. You can give a flat interest rate, you can do equity kicker, or you can move it up a little bit and do just a straight joint venture with no interest. So you have a lot of flexibility here. Loan to values anywhere from 60 to 80%. On the short term, you're going to need that 20% for profit, possibly, all your closing costs to get the property sold, your fees, commissions, title, escrow, so on and so forth. But if you're buying a house at 80%, you got to make sure it just doesn't need any repairs, that you just happen to get it at a really good price, and you're just going to turn around and carry it until you sell it and cash the deal out. Another thing about on the short term is, when you're dealing with private lenders, is you can basically get the purchase and the rehab cash right up front. So when they wire those funds into escrow, you get the property paid for, and then you get your rehab expense right there. So you take that check, then you go put that in your business account, and then pay for all your expenses that you need to get the deal done. And these loans can be anywhere from 6 to 12 months. They can be 24 months. But you know, like I said, this is all a negotiation. So these are just some points that I wanted to make to you so you can understand how to intelligently talk to some lenders about potentially loaning you on your deals. So long-term, buy and hold, these are my favorites. Because I like building cash flow, and you know, selling properties on wraps with seller financing is my niche, and that's pretty much all we do. So we're very, very knowledgeable. I have done a ton of flips over the years. They're not my favorite. I still have a couple going on now, and you know, and every day that goes by, our profits are diminishing. So that's one thing that we love about long term, is because from the day you sell the house, your profits are growing. So on buy and holds, I like to try to pay a little bit less. Because I'm trying to put a margin in there to cash flow. So if I know that I'm going to sell a house at 10% interest, and I'm going to bring my private lender in at 7%, so basically the sell on that to your lender is, look, you're going to make 7% and I'm going to make a 3% spread. And I deserve the right to do that because I'm putting the deal together. I've bought the house, sold the house, managed the whole process. So, you know, a 3% spread is common, you know, and that's something you just have to explain to your lenders. Fully amortized loans, anywhere from 15 to 20 year. If you can stretch them out to 30 year, I wrote here 30 year with a 5 or 10 year balloon. So you have some different ways to structure the payments in a way that you can get your payment low, give them a nice rate of return on their capital, but also if they don't want their money out for 15 or 20 years, you know, you can think about doing an interest only loan with a 3 to 5 year balloon. You know, you can structure it for a 30 year to amortize it for 30 years to get the payments really low, and then have like a 5 year balloon on there. And within that time, if you sold it with owner financing, you can sell that seller finance note and cash them out, or you can take that note and go pledge it with another lender and refi them out. So you have a lot of options here. My favorite are the fully amortized loans because it's paying the interest and the principal down month to month to month. And like I was saying, if you have an investor that just doesn't want their money out that long, then you can, you know, negotiate having a balloon or a call in there, whatever the case may be. You know, if they're willing to give you 5 or 10 year capital, then you should definitely take advantage of that. You know, loan to value 60 to 95%, you know, depending on how well you can negotiate a discount on the property that you purchase. You know, up to 95%. You know, if I know that, you know, in my market, you know, properties are appreciating 3 to 5% a month right now. So it still puts them in a nice position because I know I'm going to mark the property up and sell it. So it just depends on the deal. You know, not all deals I'm going to pay 95% for. If I'm going to pay 95% for a house, I'm going to get the seller to carry back financing to me, and I don't really need my private lender. But if you're making offers on properties all cash and you know you got your private lender in your back pocket, then you know you can pay a little bit more because, you know, you have some good terms structured in the deal and you know how to get your spread in there. And you can also, you know, draw the cash to purchase the property, and if you need to put a little bit of repairs in there, get it cleaned up, paint it, you know, carry it for a, you know, a month or two or something like that, then just know that you can add that into the loan. So if you're going to buy a house for $50,000 and you need $10,000 to get it ready, then you know, basically borrow $60,000. Pull the $10,000 out at closing, and then, you know, make sure you do good bookkeeping so you can track all your expenses in there. You know, then you're going to turn around and sell the house for $75,000, $85,000 or something like that at 10 or 11%. So just want to give you some really good golden nuggets here. And if you are a private lender just looking for, you know, investments, you know, you can reach out to us at support@freedominvestingacademy.com. If you have any questions about this video, or you'd like to jump in a conversation about how we can negotiate short-term deals, long-term deals, I'll be happy to answer any of your questions. So I hope this you enjoyed this video. You can see a lot of benefit in there. So follow us on our blog. Come hang out with us over at freedominvestingacademy.com, and I'll see you on the next video.